Welcome to Openpay's Q2 FY21 Results Investor Briefing. My name is Jane Lowe and I'm the Managing Director of IR Department, and it's a pleasure to have supported Openpay with investor relations through what was both a strong and exciting quarter. Thank you all who have made time to join this call, where we will discuss Openpay's results for Q2 FY2021, which was the quarter ended 31 December 2020. Presenting today will be Group CEO and Managing Director Michael Idle, CFO Yusi Nunez, and the company's new US CEO and Global Chief Strategy Officer, Brian Schneiderman. Michael, Yusi, and Brian will talk to the highlights of the presentation that was lodged with the ASX this morning. The formal part of this session will be followed by Q&A. If you'd like to ask a question, you can do so at any time by entering your question into the Q&A function below. We will get through as many questions as we can in the time that we have. I'd like to now hand over to CEO Michael Idle. Thank you, Michael.
Thank you, Jane, and good morning, everyone. Thank you for making time to attend today's Q2 FY21 results presentation. Let me start with a bold, proud statement. In the December quarter, Openpay has experienced its best quarter on record in multiple aspects. We have reported huge growth in our key metrics in both Australia and the UK, but also, and perhaps even more importantly, have positioned our company for what we expect will be step change growth. We will talk about some of the initiatives we have put in place to keep pushing ahead in Australia. We will also touch on the next phase of our UK expansion and cover our launch plan and activities into the $5 trillion US retail market. After my comments on our business performance and overarching growth strategy, Yusi will talk to our financial performance and funding, whilst Brian will focus on the strategy and execution of our US launch. Starting now with our performance during the December quarter. Following the excellent trading results in Q1, we were expecting a robust business performance in Q2, but this quarter also to be a moment of truth for how we would perform in this highly contested retail sector during peak season. I'm now more than pleased to say that we have performed exceptionally well in Q2, above our expectations, both in retail and in our specialized verticals. Just 3 months after we passed the 1 million mark in active plans, we reached 1.447 million plans in December, the largest quarterly growth rate on record, and a 213% year-on-year increase. Our very healthy trend towards comparative longer-term and higher value plans prevailed. We have originated more than 73% of our TTV with 3 to 5 month plans. These longer-term plans are where we can make a true difference for the merchant and the customer. And in Australia, as we know, we earn fees from both, which of course supports our market-leading gross revenue yield, which I will allude to in a moment. We recorded growth in active customers of 123% relative to PCP, finishing with 461,000 active customers across Australia and the UK. Notably, the rates of repeat usage, now 77%, of customers with multiple concurrent plans, 49%, and with plans across various merchants, 32% in Australia, have all continued to improve. These very strong numbers reconfirm the trend that customers are making it routine to use our Buy Now, Pay Smarter product to manage their cash flow smartly. Across Australia and the UK, the active merchants metric for the end of Q2 FY21 was 2,766, up 46% on PCP. We had the strongest quarter-on-quarter active merchant growth rate, up 21.4% for the quarter. This very strong increase is mostly due to the successful recent launch of Openpay's automated self-service program, which significantly simplifies the sign-up and onboarding, particularly of small and mid-sized merchants, complementing our continued strong sales focus on enterprise merchants and aggregators, for example, managed software platforms like Ventana or e-commerce platforms like BigCommerce. We are proud of all of our merchant wins in Q2. We want relationships across all verticals, which not only means choice for our customers and volume growth. It also enables us, and that's really important going forward, to further drive our healthy mix of complementary high margin relationships in auto, health, home, and the other verticals, and high growth relationships, particularly in retail, to support our market leading gross revenue yield. Some more detailed comments now on this key metric. In Q2 FY21, gross revenue yield landed at 7.5% from 9.1% in Q1 FY21, which we clearly attribute to the massive volume increase in lower margin retail through the pre-Christmas peak season. To put this into perspective, we experienced strong growth in our core verticals with an active plans uplift of 40% in automotive and 66% in healthcare versus PCP. However, our retail business recorded above proportion plan growth of 244% in Q2 FY21 versus PCP. In the current third quarter, we expect this strong seasonal domination of retail growth in Q2 to be balanced out more in favor of our specialist verticals. We saw a huge uplift in our TTV, total transaction value, which finished the quarter at $97.1 million. This was a 96% uplift year on year and an unprecedented 43% increase over the prior quarter. This was also driven by record high daily purchase volumes of more than $1 million around Black Friday and Christmas as a result of increased awareness and availability of Openpay across our strongly growing active merchant base. A brief update on B2B. During Q2 FY21, the onboarding of further Woolworth business customers onto our innovative B2B SaaS solution, Openpay for Business, resulted in continued revenue growth for this capital-light, high-margin business. During H2 FY21, we expect the rollout of B2B across all of Woolworth stores to be complete, enabling all those trade customers who have been onboarded to transact at Woolworth Group banners, including Woolworth supermarkets and Big W, in-store and online. We are also negotiating further B2B agreements expected over the remainder of calendar year 21 in Australia, and we have commenced discussions with international merchants introduced by Austrade through its high growth export services program. In the UK, Openpay experienced its strongest quarter of growth to date, with active plans increasing 70% compared to end of Q1 to 506,000, contributing now 54% to Openpay's total active plan growth. UK active customers increased 45% to 216,000, also compared to end of Q1, contributing 75% of all growth in active customers for the quarter. So an exceptional contribution of the UK to our overall growth metrics. Notable merchant launches in the UK were the Hut Group with some of their leading brands. And we also launched with a number of fragrance brands, merchants in sports and luxury goods, and children's educational toys, further diversifying the UK retail offering. To conclude, we have been extremely happy with the company's strong operational performance in Q2 FY21. We have made substantial progress on our goal to create a great business and company. And we have done this in line with our vision to change the way people pay for the better via the core pillars of our growth strategy. We feel particularly encouraged by the excellent growth rates of our leading indicators in Australia and in the UK, and the positive ratings and feedback we get from our merchants and consumer customers. A few words now on our UK strategy. Since our launch into the UK market around 18 months ago, we have deliberately focused on building a strong base of active customers in the retail channel. As you have seen, the UK business has picked up considerable momentum, and we are now preparing to launch into other verticals. As we have experienced great success with this approach in Australia, our plan is to introduce our retail customer base into opportunities within the healthcare and automotive channels in the UK. We expect to provide you with more news in due course. I will now hand over to our CFO, Jussi, who will discuss our financial position in more detail before Brian provides more flavor to our launch into the US, the world's largest retail consumer and payments market. Over to you, Jussi.
Thank you very much indeed, Michael, and good morning, everyone. As Michael mentioned, we are very proud of the group's performance in the second quarter of financial year 2021, and really look forward to an exciting second half of the financial year. What I will do is really to touch upon our key profitability metrics that complement the business performance numbers that Michael spoke about earlier, and also outline some seasonal portfolio dynamics. So firstly, as Michael mentioned, the $97.1 million in TTV written during the second quarter came at an overall gross revenue margin of 7.5%, which translated into $7.2 million. And when combined with the first quarter result, resulted in a first half margin of 8.1%. Despite reducing somewhat from prior periods, we're actually very happy with that performance, as it reflects the significant retail volumes registered, especially during November and December. Our verticals themselves noted stable margins, as they have done for a sustained period already. And whilst we note the slight margin reduction in the quarter, we really see the strong acquisition of retail vertical customers, or retail customers, as a truly key component of future success through a deeper relationship, including the use of Openpay in other verticals as well. And look, with regards to the net transaction margin, these were 1.1 and 1.6 for the second quarter and first half respectively. Drivers of this trend follow exactly what I just mentioned about the gross revenue margin, and where we actually typically see a bit of a rebound in the third quarter, where TTV, or where the TTV mix isn't as heavily skewed towards a retail vertical. Also, the second quarter's net bad debt ratio was reported at 2.3%, with a first half result of 2% flat. Look, it represents a slight increase from the first quarter, although sits firmly within acceptable parameters that we set ourselves internally, between 1.5 and 2.5%. So good there as well. Secondly, if we look at the funding and the seasonality that we noticed in the second quarter of the financial year, and is a quarter where we really see that TTV volumes are pronounced, we were really comfortably able to support the increased business through healthy overall cash balances and funding facility levels. Also, due to the roughly 4 months average cycle of our plans, we really expect a significant inflow of funds from customer repayments within the first quarter, so at the Jan to March quarter, which will actually bolster our cash balancing. They will bolster our cash balances, bringing them back to more normalized levels, that we've seen in previous quarters as well. And also, look, finally, very important for me, we are also very pleased to note that all of our funding facilities, as at the end of December, were within required servicing parameters, relating to both quality of the assets and required volumes written. So that means that we can access and maintain availability of increased funding levels, such as the GGC facility, up to 60 million pounds sterling. So an overall excellent quarter of business performance, with key growth drivers delivered at record levels, with an exciting outlook for the second half of the financial year and beyond. So to complement this, in our view, we also delivered really robust financial metrics that keep us on course to profitability as per our expectations. Okay, so look, next I'd like to hand over to Brian Schneiderman, our US CEO and Global Chief Strategy Officer, to walk us through our approach to expansion in the US market. So thank you very much, everyone, and over to you, Brian.
Thank you, Jussi. Good morning, everyone in Australia, and evening here in the United States. I'm really delighted to be speaking to you all today, having had the privilege of recently becoming Openpay's US CEO, as well as the Global Chief Strategy Officer. Incredibly important roles that I'm thrilled to take on at a very, very critical time. So there's a number of reasons why Openpay's expansion beyond Australasia and into the UK, and now beyond that into the massive US market, as what we're calling OPY USA is so important. So OPY, giving homage to our stock symbol, is the name that we're using here in the United States. First, Openpay's highly differentiated, really clearly better buy now, pay later solution for the US consumers and merchants is greatly needed in the United States, in the US market here. Second, while the company can compete very well in retail with transaction values below 1,000, it's that sweet spot for supporting the higher value transactions up to $20,000 that's so exciting. That flexibility in transaction ranges, it increases Openpay's market range beyond the low ticket and low value retail to include the verticals that matter the most oftentimes to consumers, the healthcare vertical, auto service and repair, home improvement, education, and other large ticket retail areas. But there's a lot more to Openpay's opportunity here in the US that meets the eye, that makes it really, really exciting at an entirely different level, really. The US market is a massively larger market than Australia and the UK. And in the US, there is an ongoing, unresolved, systemic, and age-old conflict between merchants and credit card issuers. Without regulated credit card pricing and with card issuers having a very strong grip on the consumer by way of the preference, the incredible preference here in the US for credit card rewards, it's largely been left to the commercial market to innovate itself out of this challenge. What OPY does and will be able to do in the US market is much bolder than what it seems at first glance, with the value proposition, sort of the baseline, if you will, that we mentioned above about our flexibility in larger transactions. OPY will be the first US company to introduce this model and boldly lead the merchants towards the payments alternative that they've really sought for so long. This value proposition that I'm referring to has the potential to drive more revenue at scale. It could do so at a lower total cost of consumer acquisition and processing for merchants. Pretty bold vision. It could redirect the consumer loyalty to the merchant rather than the issuing bank and the card networks. It gives merchants instant access to working capital by using the instant payment rails. At scale, merchants would receive a much more valuable and therefore cost-effective payment solution than the interchange-based credit card model that they're often forced to accept today. So what do you have to believe for this to be true? Well, a material proportion of the US market would prefer an installment payments approach with rewards at zero interest rate over credit cards for higher dollar transaction. OPY's transparent pricing and clearly stated fees and terms versus the revolving open-ended nature of credit cards is a key feature that will attract consumers who are seeking control and the ability to budget. Second, given only 30 days to pay with no periodic interest rates via credit cards, those other offerings pale to compare with 12 to 24 months via OPY. So OPY is not limited to consumer spending. Small business owners can use our offering to replace their unexpected broken equipment. Say the QSR, the quick service restaurant that has a pizza oven that goes out or a refrigerator that goes down. OPY customizes credit to the consumer's borrowing situation by considering the consumer and the merchant SKU together with an offering fixed term. So the result is a tailored credit product that helps consumers and borrowers succeed by enabling them to repay on time, which in turn allows access to credit expansion, and in turn for merchants creates opportunities for market expansion. This is intended to be achieved through a strong wholesale distribution strategy beyond just retail and network environment where we have a group of organizations working together to get to scale. OPY here in the US is lining up with very large banks, US banks, processors, the payments processors, the merchant aggregators, and the online marketplaces. In addition, the team OPY has assembled to accomplish this bold vision that I'm describing consists of a lot of veterans from the merchant and payments world. We just announced the appointment of Efrat Yellen as our US CFO, and she comes with tremendous experience in fintech, banking, and private equity industries. And it's leadership like ours that helps prime the market for OPY in the US, and why I strongly believe in the significance of OPY's US sunrise. I'm very excited to be taking OPY down this new and exciting transformational journey. I'll now hand it back to you, Michael.
Many thanks, Jussi and Brian. Great update from your side as well. So as you have heard, to kind of wrap it up, the December quarter has delivered very, very strong operating and financial results across all areas of our business and provides us with a very healthy basis for further accelerated growth in 2021 and beyond. The launch into the US, as outlined by Brian, represents a quantum leap opportunity for our business, with OPY first launching into the buy now, pay later sector with our differentiated approach as alluded to, and then into B2B midterm. With a market size of $5 trillion US, the US retail sector transacts around 20 times the purchase value of the Australian retail sector, a massive market. The combination of our longer term and higher value plans and verticals, which we will focus on with market sizes in the 3-digit billions, will add another dimension of growth. The adoption of buy now, pay later in the US is, at least at the moment, far behind Australia. And the demand, as Brian has explained, for better payment solutions is even more pronounced than it has been in other markets due to the highly fragmented payments landscape in the US. The same applies, by the way, in the B2B space, where comprehensive payment solutions for businesses are lacking even more. This is a once-in-a-lifetime opportunity for growth for OPY, which we are prepared and determined to capture. We are convinced that our buy now, pay smarter approach and our software as a service solution in B2B, plus our focus on strategic partnerships, will set us up for the next level of scale and growth. We will work with enterprise retailers, payment processors, and banks. We will integrate further into large business platforms with critical masses of customers accessible in one hit, if you like. We will use product innovation to engage our customers. And we are steadfastly focused on our geographic expansion within the US and in the UK. The discipline of a highly talented and experienced team in all our markets to deliver meticulously on our strategic plans and promises has the potential to position Openpay as a global provider of market-leading payments and digital lending services based on our mission, again, to change the way people pay for the better. We look forward to keeping investors updated on our progress. Thank you. And with that, we will now enter the Q&A part of this call, which Jane will moderate. Over to you, Jane. Thank you.
Thank you, Michael, Jussi, and Brian. I'd now like to open up the session to questions. If you'd like to ask a question, just a reminder, please type it into the Zoom Q&A function via the ribbon on your screen. We've got about 15 minutes for questions this morning. So if you have a question that we don't field in the time that we have, please feel free to send it through after the session to investors@openpay.com.au. And we do have quite a lineup of questions ready to go. So thank you, everybody, for those. So the first one from Danny Yunus, of course, at Shaw & Partners, who covers Openpay. So great to see merchant growth accelerate in 2Q21 after some lower growth quarters previously, and was one of the highlights of the result in my view. Can you talk more about what the specific drivers were that enabled this 46% lift in growth?
Thanks, Danny, for that question. And indeed, one of the highlights of our announcement today. And you look at particularly the Q1 growth rate, which had been versus PCP 35%, and now within a quarter up to 46% is remarkable indeed. And just to allude to the two drivers to that trend, which we intend to continue. First, we continue to focus on the big end of town, large enterprise merchants who bring substantial growth opportunities, scale, transaction volume, and customers who we then can cross-pollinate into the other verticals. So that's a continued contributor to our active merchant strategy. Secondly, and that's new, we have introduced in late Q1 a new kind of self-service onboarding capability, which suits smaller and mid-sized merchants particularly well to basically do the whole job themselves. They have a rate card, they have a merchant agreement, they find the widgets and assets to integrate easily into e-commerce particularly. And the launch of this technology capability, if you like, to complement what we do well on the big end of town now into the smaller merchant space, has from the beginning worked really, really well. And going forward, we will continue to focus on these two streams to really get the number of active merchants up, which informs all the rest, active customers, active plans, TTV, and revenue.
Thank you. Okay, so the next one to do with the US. So the US is a massive market and a major land grab is now going on there with all players. Clearly, you are approaching that market in a differentiated way versus your peers by way of plan lengths, differing verticals, etc. Can you talk more about the timing of funding partners and payment processes? And given the addition of a CEO and CFO, what the cost base is likely to look like in the next 12 months as you build scale in the US?
Yeah, Brian, I think you're best suited to answer that question. Thank you.
Yeah, so you're right. The differentiation is clear, and we have been exposing the differentiation to the U.S. market now for quite a while as we've been in discussions priming the market. The difference of the combination between the larger, longer, and deep verticals matters. There is a lot of white space that isn't really addressed. And there's also a lot of merchants that just simply aren't happy with the options that they have, as I was alluding to earlier in my comments. So it really is about knowing those verticals and being able to time and bring plans that are tailored to the length of that specific vertical or sub-vertical, like orthodontia, and being very flexible with what their needs are that meet their business cycle, whether it's a 14-month type of treatment that somebody needs, or in home improvement, how long it takes to install a large air conditioner. These needs are not met in the US market. That combination doesn't exist. The cost basis, when you look at the size of the US market, it is really not proportionately a concern of ours. The market is so big and we have an existing platform that we're Americanizing. We have a great basis to build upon. We're not building from scratch. So really, we've got a lot of opportunity in the market without a lot of investment required proportionately. And the overhead that certainly that I bring, and the CFO and the others that report to me, really not a concern. Michael, back to you.
Thank you. That's right. And yeah, just getting the next one from Jane. Thank you.
Okay, thank you. So now to the UK. So with respect to the UK, given it's still relatively early days there for you, are you expecting the UK to accelerate in future quarters as you move into auto and healthcare, and the product gains traction in that market with larger wins like the Hut Group and JD Sports and others to come start ramping up?
Yeah, that's exactly right. We expect now accelerated growth in the UK on the back of merchant wins like JD and the Hut Group, which show ever increasing TTV volumes and number of plans. And obviously, there's a lot of consumer customers who we then kind of market into the other opportunities within retail. And now preparing for the launch, particularly into auto and health. This will first of all bring new merchants with their own customer base to the mix for us to really play to our strength. And I think the same what is valid for the US is valid for the UK. There is not really a great opportunity and offer in the market in these longer term and higher value purchase areas, which we will cover with our plans. But we can also then take the customers and the ever increasing number of customers from retail into these verticals to add to the merchant's customer base. And this will inform the growth dynamic which we expect now over the next quarters in the UK.
So the next one is, I've received two similar questions, so they're on financing, UC, so I might put them to you. So the first one is, are all of your financing facilities actually available, or does it require an increase in receivables in order to borrow against them? And the sort of related question is, why are a large portion of funding facilities uncommitted, and what impact does this have on their availability?
Yeah, no, thank you for that question. And the structure of our funding facilities are very standard within the market. That yes, they do require usage. So look, from a funder's perspective as well, you know, for their funding to be well utilized, they want to make sure that those lines are being used. So absolutely, look, when we talk about committed, uncommitted, we have a series of triggers and performance indicators, which I outlined before, relate primarily to making sure that we are hitting volume targets, which we have in all facilities to date, as well as the quality of the assets, so that we are writing good quality assets and not bad. And with all of those targets being met, it is absolutely an expectation that all of these facilities then become committed, and as we then also develop and evolve our funding strategies. But yes, at this point in time, we are perfectly performing in all funding facilities, and that will unlock further funding for us going forward.
Thank you. Just while we're on you, UC, there's a question here about actual TTV in the UK. I note, of course, that we've got our half-year results coming up soon as well. So the question was, what was the actual TTV in the UK?
Yeah, look, probably without disclosing exact numbers, the TTV for the for UK in the last quarter, or the October to December quarter, was between 30 and 40% of global TTV.
Thank you. Well done. Okay. So perhaps one back to the US market, maybe for Brian. So I don't know if you want to just add some extra color to this response, but so the question is, can you please explain how OP will differentiate itself from big players in the US, such as Afterpay and Sezzle?
Yeah, well, it goes back to the combination, really, of the things that we do that are different. Our approach, while we will be offering and going through the retail channels, our approach is to partner up with some very large aggregators in the US to go after the market. Those aggregators are oftentimes very focused on a specific sub-vertical where they have unique needs, where we're tailoring to what they do. We're integrating within their solutions so that it is very much a product that is focused on an unmet need currently. And so that's what I can tell you is those relationships, that stickiness, if you will, within those verticals is something that others aren't doing. Now, strongly believe that consumers are going to enjoy OP to the extent that they'll want to take that and use that in other areas outside of our biggest verticals. But we believe we can make the strongest difference in particular areas, and then consumers will fall in love with it as an alternative, not only to the other buy now, pay later products, but to the use of cards, again, that only allows them, say, 30 days. It's proving out, based upon our analysis, to be a very good strategy, and that's what we think is gonna have us succeed. And by the way, there are many times we sit alongside others because we're so differentiated. We're not actually competing with them. So I would suggest you think about it as still a very immature market. It feels like it's very mature because it's growing so fast, but there's still a lot of unmet need where we do some things different than our competitors.
And if I just may add to Brian's point, which are all absolutely right, from a product perspective, what most of our competitors in the US offer is a pay-in-4 product, up to 2 months, often 6 weeks, which is an unregulated product from a credit license perspective. And this covers, as we know, a beautiful part of lower value retail, where it's really, as we have seen, getting great traction. What we can do with our flexible platform is offer longer term higher value plans, 3, 4, 6 months, or in US terminology, pay in 6, pay in 12, pay in 18. And this is then a regulated product, what you need credit licenses for. And this is what we are in the process to obtain over the next month to launch into this area of opportunity where our competitors largely do not really reach into, and where we see a massive demand from merchants and consumers. Just to complement on that perspective from Brian.
Yeah, if I could just tack onto that one additional thing, which is a lot of consumers will start off maybe with a pay in 4. They'll get used to using buy now, pay later. But if they don't have the option to use a variety of types of plans based upon the very specific nature of what they're buying, they might go from buying a $250 item and now they like it, they like how it works, and they've got a $5,000 dental treatment that they need to pay for. They can't go anywhere with that. We can go all the way up and down that value chain, and that's really going to be a difference for us. And when consumers start using OPY, they'll get used to it. It's much more usable across the full spectrum as a payments instrument, not just a loan.
Thank you. And we've obviously demonstrated that in Australia very well to date. So nice to round off with that point. Okay, so another funding question, and then I might have another funding question for you after that, UC. So you mentioned OPY is well funded. Given your expectation of rapid market expansion in the US, do you anticipate another capital raising in the medium term?
Well, if we speak about funding just by itself, clearly the negotiations and discussions with the larger banks that we're doing will absolutely address the funding side of things. But clearly, according to need in the future, capital will have to become a discussion point. Perhaps, Michael, anything further to add from your side? I mean, from a funding perspective, funding our books, absolutely, we are addressing that, and we are very far progressed with getting these over the line. But in terms of funding from a capital perspective, perhaps, Michael, just a brief couple of words from your side.
Yeah, absolutely. I can confirm. I think we are really well funded to further grow the book as demonstrated in the past, and we will be ready now with the upcoming debt funding facilities with senior and junior funders in the US to cover that growth. And as Brian has alluded to before, we can build on a lot of assets, our technical platform, our products and our capabilities from Australia into the US, which will kind of mean that our incremental operating expenses will be reasonable. And that's what will take us now into this Q3 and further kind of effort to land our products and the required relationships in the US. And we will see midterm how that plays out.
Thank you. Okay, so now a question on verticals. So is Openpay considering adding new verticals like travel in particular?
So this is a constant kind of evaluation which we undertake in any market, listening to our merchants and our customers where they would like to present us or use us. And travel is an interesting vertical. We are now at the moment in Australia, as we have disclosed, focusing really on getting even deeper traction into auto, health and home, where we are at least one of the leaders of the market, and continue to expand into sports memberships and education, which is very, very promising and working well. There's also a range of opportunities in utilities, in, as mentioned, travel and other areas, which we will look into over time. So we are absolutely open. We follow our customers, our merchant, where it makes sense, where it adds value. We will onboard these verticals over time.
Thank you. Okay, we do have quite a few questions left, but I'm conscious that we're fairly close to time. There are an unusual number of questions about Zip today, so I might just throw one towards you, Michael, and we might make this the last question given where we're at in terms of timeframes. But again, if anybody has questions that they'd like a follow-up response on them, please feel free to contact us via email, investors@openpay.com.au. So this is on Zip in the Australian market, and there's also interest in the UK market. How does your product differentiate itself from Zip Money?
Yeah. So from the outset, I think what we can say from a product perspective, as the market knows, as we know, Zip offer a Zip Pay product, which is a paying for short-term product, and a Zip Money product, which is an interest-bearing, longer-term, higher value plan structure, if you like. I think the main difference here is we never charge interest. We are an interest-free product. There's no hidden catches, which comes with interest-bearing products. We are kind of transparent to the consumer upfront, what they will pay as fees over the full duration of the plan. And that's really then what it is. So what they see in the beginning is what they will have paid in the end. That's maybe one important aspect. And we cover, similar to Zip, the full range of up to 24 months and up to $20,000 across multiple plans, which gives a huge flexibility in the market. And we have originated three-fourths of our volume and plans over the quarter in plans longer than 2 months, so 3 to 5 and longer. So even with strong competition with Zip, we have been seeing extraordinary growth, in particular that part of the business. In the UK, to our knowledge, Zip focus on a short-term product, not the differentiation which we see with Zip Money in Australia. And we are in the UK market up to 11 months, and the respective value different to some of the merchants where we offer it. So we already play there into this longer space, which also gives us a great entry point into these verticals. So that's probably the main differentiation.
Okay, excellent. Well, thank you, Michael. With that, I might hand it back to you for closing comments.
Yeah, thank you very much, colleagues and ladies and gentlemen. Thank you very much for joining us on today's call. I look forward, and the team look forward to updating you on our progress again soon. As always, as Jane has mentioned, if you have any further questions, please contact our investor relations team or reach out to me directly. Thanks again.